All right. Welcome everyone, and thanks for joining this webinar to learn more about criminality in a multi-chain world and how you can use blockchain analytics to address cross-chain risks. I'm Tung, the Senior Policy Advisor for APAC at Elliptic and your host for the session. Prior to joining Elliptic, I was with the Monetary Authority of Singapore and spent my career largely with the Singapore public sector. Joining me today is Arda, a Senior Crypto Threat Analyst at Elliptic, who will use our holistic screening tools to illustrate the criminal exploitation of cross-chain services through various case studies. He also contributed to our inaugural report on the state of cross-chain crime that was published last month. If you have not read it yet, we will share a link after the webinar via email. A quick intro for those of you who are less familiar with our work. Elliptic was set up in 2013 and is the pioneer in blockchain analytics. Our solutions are used by law enforcement agencies and regulators to trace illicit proceeds across assets and blockchains for supervision and enforcement actions. We also help virtual asset service providers, or VASPs, financial institutions, and other businesses mitigate their money laundering and terrorism financing risks due to either direct or indirect exposure to crypto. Before we move on to the exciting presentation that Arda has prepared, allow me to give a brief overview of cross-chain services and why they are increasingly targeted by malicious actors. From a world dominated by Bitcoin and then Ethereum in 2015, the crypto asset ecosystem has been completely transformed over the past few years. The increasing popularity of decentralized finance, or DeFi, has meant that value now flows far more freely between crypto assets and blockchains, making crypto more useful and valuable. However, it also completely transformed how criminals launder proceeds of crime in crypto through different assets and blockchains. Bitcoin, of course, is no longer the only blockchain. There are now hundreds, such as Solana, Cardano, and Stellar, that use various technologies and address different use cases. With the increase in the number of distinct blockchains, the number of different crypto assets on these blockchains has also soared, with more than 10,000 different tokens now in existence. This has been enabled in particular by smart contracts on blockchains such as Ethereum, which allow anyone to create their own crypto asset tokens. And you have seen them being used for fundraising and as governance tokens, among other use cases. The crypto economy has become considerably more diverse. However, until recently, each asset and blockchain has been fairly separated and isolated with minimal native interactions across the different blockchains. That's because in order to move capital from one asset or chain to another, you generally needed to use a centralized exchange, a business that allows crypto assets to be swapped. This created friction because such transfers or swaps could not be done on-chain through crypto transactions. It had to be an off-chain swap intermediated by an exchange. But that changed with the emergence of DeFi, which seeks to replace centralized intermediaries and businesses such as exchanges with automated services that run on blockchains in the form of smart contracts, what we call decentralized applications, or DEXs. What this means is that if I want to swap a crypto token for another on the same blockchain, I no longer needed to go to a centralized exchange. I can achieve the same effect through a single transaction by making use of a decentralized exchange, or DEX. These DEXs provide a peer-to-peer exchange mechanism that allows users to trade tokens without relying on an intermediary. The terms of the trade are defined and automatically executed by code, as well as being recorded on the blockchain. This has greatly reduced the friction in exchanging one crypto asset for another and made all these crypto assets far more interconnected. In the past year alone, DEX trading volumes have surged from about US $18 billion to more than US $300 billion each month, becoming real competitors to their centralized counterparts, as you can see by the chart here on the screen. One limitation of DEXs, though, is that they only operate on a single blockchain and only allow the exchange of assets that are issued on that same blockchain. So, for example, they cannot be used to send assets between Bitcoin and Ethereum. However, such transfers across different blockchains can be achieved through a virtual service known as a blockchain or cross-chain bridge. They work by accepting a token on one blockchain and in return giving you a token representing that asset on another blockchain. This can be done through a lock and mint mechanism by which the service locks the converted asset A and issues an equivalent value amount of token B to the user. Some bridges also allow users to convert an asset A to a tokenized or wrapped form of it on another blockchain. So for example, a user can bridge Bitcoin or BTC from the Bitcoin blockchain to wrapped BTC or BTC worth the same amount on the Ethereum blockchain. Users can then use their wrapped BTC for Ethereum-based services such as DeFi investments or NFT purchases. Cross-chain bridges operate with varying degrees of centrality, with most making use of smart contracts to facilitate exchanges. More recently, bridges have also started accommodating other forms of crypto assets, such as NFTs or metaverse-related assets. One entity that allows users to swap crypto assets for other tokens, either on the same or different blockchain, is a coin swap service, sometimes also called an instant swap exchange or non-custodial crypto exchange. Customers typically do not need to open accounts to begin swapping tokens and can interact directly with the service's homepage to do so, as you can see here on the screenshot. In almost all cases, customers do not need to verify their identity to swap tokens, allowing them to do so anonymously. Such coin swap services typically have opaque ownership structures, with the individuals or groups behind them remaining anonymous themselves. For the privilege of remaining anonymous, most coin swaps actually charge higher commission on average than typical exchanges that comply with KYC and CDD obligations, with fees typically ranging between 0.25 to over 1%. So in this new world of many different crypto assets and blockchains, cross-chain services such as DEXs, bridges, and coin swaps, as well as more traditional services such as exchanges, perform a critical role in enabling the free flow of capital throughout the crypto ecosystem. This also means that crypto assets are no longer distinct silos, and users now move freely between assets and chains, allowing the development of more useful and valuable use cases for crypto. But of course, this brings risks as well as opportunities. Criminals are also leveraging the interconnectivity of crypto assets for their own benefit, a concept that we call cross-chain crime. It is now very common to see criminals move crypto between assets and chains in order to obfuscate their transaction flows for money laundering. This new financial crime typology has really become a standard part of crypto laundering, and the cross-chain risks that it brings have not escaped the attention of regulators and relevant bodies. So in its most recent targeted update published in June this year, the FATF identified the rapid growth of DeFi services and cross-chain activities, or what it calls chain hopping, as key emerging risks for virtual assets. As defined by the FATF, chain hopping refers to movements from one asset to another, often in rapid succession, and with the aim of evading attempts to track these movements. The report elaborated that in recent consultations, the industry acknowledged that despite the use of blockchain tools, challenges remain in various areas, including chain hopping via non-compliant VASPs. In particular, the FATF highlighted the increase in cross-chain bridges in DeFi, which enable the transfer of virtual assets between different blockchains, and warned that such DeFi protocols can be used to perform chain hopping, which can make the transactions more difficult to trace. So what cross-chain services are particularly vulnerable to criminal exploitation? Our research has identified 3 cross-chain services that are being targeted by criminals for money laundering, namely DEXs, coin swap services, and cross-chain bridges. Ransomware groups, thieves, and hackers, including North Korean cyber criminals, are now trying to hide their ill-gotten funds by moving billions of dollars across assets and blockchains via chain hopping before laundering them through regulated businesses. This is similar to a drug dealer swapping US dollars into yen and then into Singapore dollar at different money changes before depositing them at the bank with the aim of obscuring the original source funds. This emerging risk arises as supervisory and enforcement capabilities have struggled to keep pace with the criminal exploitation of new technologies. Why is this so? In a single asset and blockchain world, money laundering is relatively straightforward. Bad actors will employ different techniques to evade detection and the seizure of funds. Any obfuscation method aims to add complexity to the money trail to make it harder for regulated VASPs to trace back and identify the proceeds of crime. However, the picture is significantly more complicated in a crypto ecosystem involving many different assets across different blockchains with high interconnectivity. As you can see from this diagram here, in the multi-asset and blockchain world, a number of different money laundering techniques can be used to leverage the wide variety of assets and chains to layer proceeds of crime, whereby the true source of funds is concealed through a series of transactions. So in traditional finance, this might mean, for example, sending funds through accounts at multiple financial institutions, perhaps offshore accounts, or exchanging cash for prepaid cards, gift cards, and other assets. Moving proceeds of crime between crypto assets and blockchains is just another way of doing that, and made even simpler if bad actors use services that are not regulated or do not impose strict KYC CDD requirements, such as DEXs, cross-chain bridges, and coin swap services. Each of these techniques shown here helps to separate the money from its illicit source, and the decentralized nature of many such services makes tracing such transactions across assets and blockchains extremely challenging. So imagine what happens when criminals use a combination of all these different services and techniques to layer illicit proceeds. The number of hops, tokens, and blockchains involved, and the speed at which such value transfers occur can be mind-boggling and difficult for regulated VASPs to detect despite their best intentions. What we're describing here today isn't isolated and infrequent incidents. Cross-chain and cross-asset laundering is now very much standard practice in crypto and is getting more sophisticated based on our research into cross-chain crime. So I previously mentioned our State of Cross-Chain Crime report. Without going into the details, let me recap some of the headline figures here. So in the last 2 years, about US 1.2 billion worth of illicit crypto proceeds was swapped to other tokens through DEXs. The use of DEXs by criminals is closely associated with exploits in the DeFi space, as well as hacks of centralized exchanges, where approximately US 3.3 billion of funds have been stolen through such crimes across over 80 incidents since late 2020. More than 750 million worth of illicit funds have been laundered through chain hopping facilitated by bridges. The vast majority of these illicit assets, over 540 million, have been processed through Bridge, a cross-chain bridge used predominantly to exchange assets between Bitcoin and Ethereum. With their strong nexus to Russia and lack of KYC requirements, coin swap services have been used to launder more than 1.2 billion worth of illicit crypto assets. Several illicit coin swap services are advertised on the same cyber criminal forums as the illicit vendors and services laundering proceeds through them. This indicates that many of such coin swap services are strongly integrated with the cyber criminal underworld. Entities sanctioned or eventually sanctioned by the United States constitute approximately 1.5 billion worth of illicit crypto assets being processed by these three cross-chain services. Such sanctioned entities include Tornado Cash, Suex, Chartex, Garantex, and Hydra. In addition, DEXs, bridges, and coin swap services have also processed over $350 million worth of funds stolen during crypto heists suspected to have been orchestrated by the Lazarus Group. This means that in total, over 1.8 billion worth of crypto assets being processed by such services are potentially associated with entities sanctioned by the United States. So after going through all these statistics on cross-chain crime, a natural question is what we or Elliptic can do about it. So though Elliptic may have pioneered blockchain analytics, we recognize that it will be difficult for legacy solutions to trace different assets within one blockchain and across multiple blockchains. Existing blockchain analytics also could not easily trace transaction flows through cross-chain bridges, often stopping at such services as labeled entities, or only able to detect some of these activities through manually intensive investigations. For the past few years, we have devoted resources to develop the next generation of blockchain analytics that can conduct automated screening to detect cross-chain money laundering through DEXs, cross-chain bridges, and coin swap services. Before I hand it over to Arda to introduce himself and showcase his excellent work on cross-chain crime using holistic screening, a bit of housekeeping first. So we have invited attendees to pre-submit questions, which we will address or have addressed so far during our presentation. And we also may go through some of them at the end of the session. Depending on time limit, we may also take questions from the audience. So if you have any, please pop them in the Q&A session in Zoom. Just so you know, we will be sharing a recording of the session afterwards as well. Without further ado, take it away, Arda.
Thank you very much, Tung. I think that was an amazing introduction to the problem that we face in today's crypto ecosystem, and the sort of research that we have already done to sort of highlight where this problem is coming from and to what extent it's coming from different aspects. My name is Arda Akartuna. I am a senior crypto threat analyst here at Elliptic. I have been here for about a year and a half now, and my job is basically to identify illicit sources that are using crypto assets for any kind of illicit purposes, be it money laundering, be it sanctions evasion, be it terrorist financing. And of course, cross-chain crime, as Tung has said, has been an increasing sort of trend that we have observed when looking into these sanctioned entities or illicit entities, ranging from ransomware, dark web markets, etc. And I think, of course, the FTX hack that has happened over the last weeks is perhaps the sort of latest major case study, if you like, that showcases truly why this is a problem that, as blockchain related businesses, we need to sort of address. And that will be an example, a case study that I will quickly walk through towards the end. But before sort of going into how Elliptic's new holistic screening capabilities can really help in mitigating and managing and identifying the risks of cross-chain crime, it's probably worth going through exactly what we're looking for, on the blockchain. So why are criminals going cross-chain? Why are they using coin swap services, cross-chain bridges, DEXs? What sort of advantage does it give them? And to sort of understand that is to also understand, what sort of patterns we're looking for when we investigate these patterns. So I suppose the first reason why a criminal would want to go cross-chain is because, as Tung has said, it's difficult to trace. With legacy blockchain analytic solutions, you can't really trace through bridges. You can't trace through DEXs as easily. And what that really requires is for, as an investigator, you're going to have to stop, for example, at a cross-chain bridge when you're tracing a certain suspicious activity. And you're going to have to do some manual investigations, look at that cross-chain bridge, see where it's gone, see which blockchain it's been swapped to, and then continue the investigation, etc. And if you imagine a criminal sort of using a cross-chain bridge or a DEX over and over again, it becomes incredibly manual, it becomes incredibly cumbersome, and to an extent unfeasible with resource and capability limitations, etc. And a criminal knows that, right? And that's probably the sort of major sort of reason why a criminal will want to go cross-chain. The second main reason is that they might want to take advantage of crypto services. So let's assume you've committed some ransomware, and you've stolen a lot of Bitcoin, or you've got a lot of Bitcoin ransoms, and you might want to invest that into DeFi. You might want to invest it in NFTs. Now, of course, those services are not available on the Bitcoin blockchain, but they are available on the Ethereum blockchain and other similar blockchains. So what you would have to do in order to sort of go there and sort of invest your illicit funds, you would need to use a cross-chain bridge to swap from one to the other. The third is a sort of absence of alternatives, if you like. So as a lot of us have probably sort of come across, Tornado Cash is what was and still to an extent is a major money laundering tool for illicit activity. And of course, after it was sanctioned, a lot of especially US-based illicit actors looked for alternative ways to sort of launder their money. Tornado Cash is now gone. This is now unreachable for us. What's the next sort of best alternative to launder our money that we could potentially sort of use? And of course, cross-chain bridges, DEXs, etc., do sort of provide a good alternative for those who have now seen their tried and tested go-to method of money laundering, if you like, be sort of intervened upon and prevented. Also worth noting there, of course, that there are lots of mainstream mixers available on the Bitcoin blockchain. So if an illicit actor has sort of stolen funds on the Ethereum blockchain and they can no longer use Tornado Cash, well, one typology we have specifically observed is, of course, swapping it or hopping it from the Ethereum blockchain to the Bitcoin blockchain using a cross-chain bridge, and then putting it through a mixer available on the Bitcoin blockchain. And of course, it is possible to do so anonymously, as Tung has said. A lot of these cross-chain bridges, a lot of these DEXs, if not all of them, do not require KYC. They do not require ID verification, and that's what makes them so appealing to a criminal audience. Could I have the next slide, please, Tung? So moving specifically to DEXs, and the reason I'm looking at DEXs specifically right now is the sort of case study we're going to show you in a couple of slides really looks at how a certain illicit actor has potentially used a DEX to sort of obfuscate their funds. So a DEX, as Tung has said, is a sort of service that allows you to swap from one asset to another on the same blockchain. So this could be, for example, Tether to Ethereum, etc., all occurring on the Ethereum blockchain. Now, the real reason, the sort of main reasons, if you like, why a criminal would want to use a DEX specifically to sort of launder funds, and we're looking mainly at hackers, we're looking at scammers, etc. Here, DeFi hacks have massively increased, across 2021 and 2022, and what we typically see with those hackers is that they do use DEXs for three main reasons. The first is to swap any stable coins that are freezable. So USDT, USDC can be frozen by Tether and Circle respectively. A lot of hackers, a lot of thefts, basically immediately after they've initiated an illicit activity, they will swap any USDT or USDC that they have stolen immediately into a non-freezable asset, be it DAI, which is another stable coin that you can't freeze, or Ethereum. So that's probably one sort of typology or pattern that we're looking for in our blockchain analytics investigations. Swapping funds in preparation for mixing, as I've discussed, Tornado Cash, for example, went before it was sanctioned, and to an extent now, only had smart contracts for a certain number of assets, be it ETH, be it DAI, be it USDC, etc. So if you've stolen a very obscure token from a very specific DeFi protocol, you're not going to be able to put that through a mixer as is, right? You're going to have to use a DEX to then, first of all, swap it to a more mainstream asset, which a mixer like Tornado Cash supports beforehand. So it's a sort of predecessor, if you like, in the money laundering scheme to mixing, for example. Swapping funds in preparation for bridging to other blockchains is one I've just discussed in the previous slide as well. So if you want to, for example, make use of a mixer on the Bitcoin blockchain, but you've stolen a lot of assets on the Ethereum blockchain, first of all, you'll probably have to swap those funds to REN BTC, for example, the crypto asset used to swap Ethereum-based assets to Bitcoin-based assets using the REN bridge, before you then use the REN bridge to bridge it to Bitcoin, all right? So you would need to use a DEX as a sort of predicate to then be able to bridge it to, for example, the Bitcoin blockchain. So these are the sort of three main blockchain analytics patterns that we might observe when we're sort of investigating illicit activity. So if I could have the next slide, please, Tung. Thank you very much. And this is just a Sankey diagram that's actually showing you a lot of different Ethereum-based thefts on the very left. There's so many, of course, you can't really read them all, but basically what this is showing is that a lot of sort of hackers behind a lot of DeFi thefts are effectively putting their assets through DEXs. So you can see Uniswap just about, you can see 1inch, you can see CurveFi there, for example. So these are the three main DEXs that criminals have used to swap it into sort of ETH, DAI, that little purple one over there, of course, unfreezable stablecoin, like we've discussed. You can see some REN BTC again for that, swapping to the Bitcoin blockchain eventually. And you can see the sort of how a lot of these hackers take all sorts of different types of tokens, swap it through DEXs to sort of 3 or 4 major different types of assets. So that's kind of a potential typology we're looking for when investigating. Could I have the next slide, please, Tony? So just to sort of recap here, what we're looking for is we're sort of using our blockchain analytics capabilities to not just stop at a DEX and then hold there and then look at an address, see exactly what they might have swapped to, and then restart our investigation, using a different asset entirely. What we're doing is we're now using holistic screening to sort of investigate all of that activity in one simple investigation. So what I'm going to show you now is how Elliptic Lens can do that for us. If I could have the next slide, please. Right. So here we've got an address that has been screened in Elliptic's wallet screening tool, Elliptic Lens, right? And you can see that we've screened it just for the DAI stablecoin, right? So what this is showing us is how much DAI there is in this wallet. You can see that there's about $9.8 million worth of DAI in this wallet, right? And you can see that crucially, we have a wallet risk score of 0. Now, what that means is that our tool has not identified with the single asset screen any illicit source or destination attributed to the DAI within this wallet, right? So if you had screened this with a legacy blockchain analytics tool only for DAI, right, and this wallet has interacted with you, it's sending DAI, for example, to a certain exchange, etc., you would not have had any reason to think that this wallet was involved in any illicit activity at all, right? But what we can now do with Elliptic's holistic screening capability is you can see actually that, big sort of dark green or dark blue button there. When you click holistic rescreen, you actually potentially get a far more sort of, holistic picture and a far more interesting one, which might actually reveal crucial, important sort of red flags, if you like, about this wallet. So if I could have the next slide, please, Tung. So again, just before we click that button, you can see here, actually, when we look at the exposure, again, just for DAI, you can see that the source of funds is pretty much entirely from a DEX, right? It's all come from different decentralized exchanges. In this case, MetaMask swaps accounts for most of it, right? So all that DAI has been swapped through a DEX by this wallet into DAI, right? And that's why, when we look at the source of funds, we're seeing almost 99% coming from a decentralized exchange. It doesn't go further back than that. It doesn't tell us, okay, so what happened before it was swapped into DAI? What was it beforehand? What happened? So when we click holistic rescreen, Tung, if I could have the next slide. What happens is we get a very different picture, right? So this is the same wallet. We have now holistically rescreened it. We can see that the inflow of the wallet is again about 9.8 million, but crucially, the wallet risk score is 10, right? And now what we're doing is we're looking at all the assets that have come into this wallet and gone out, right, including all the DEX swaps, etc. So what we've now noticed actually is that when we sort of account for those DEX swaps and account for all those asset hopping, right, there is something quite dodgy about this wallet, given that it's now got shot up from a wallet risk score of 0 to a wallet risk score of 10. So if we go to the next slide, Tung, we can potentially see a bit more information about why that would be. So again, here we're looking at the exposure, right? So remember beforehand, just looking at DAI, we only had exposure to a decentralized exchange. What we have now, actually, when we look before that decentralized exchange, what happened to the assets before it was swapped into DAI, what we actually see now is that there is direct exposure to 2 entities sanctioned by the US Treasury, OFAC, right? We see funds coming in from Garantex, and we see funds coming in from Tornado Cash, right? So now what you can see is that now that we've screened it, looking at all the assets and all the transactions that have occurred with those assets in that wallet, we can now see crucial pictures that will rapidly change what we might do when we sort of encounter a transaction with this wallet, for example. So that is the power of holistic screening in our wallet, a screening tool, Elliptic Lens. Could I have the next slide, please, Tung? So, going on the sort of theme of sanctions, right? So that wallet that we just looked at, turns out it's got direct exposure with a sanctioned entity. And of course, that is very, very important in terms of preventing sanctions evasion. So holistic screening is a crucial tool in order to ensure that we do not inadvertently participate in any sanctions evasion. And, when we look at sort of the 3 main services that Tung talked about, CoinSwap services, cross-chain bridges, DEXs, etc., there is a lot of sanctions risk associated with these, right? So CoinSwap service, Tung showed you an example, but here are 2 more examples, right? So in the sort of bottom left, you see one that is sort of inclined to sort of be more towards legitimate facing audience, right? You know, you can, it's mainly for a DeFi audience. In many cases, you know, these legitimate facing coin swaps will potentially have some degree of, you know, AML screening, etc. implemented, but not all the time. What you see in the top right, however, is slightly different, right? You see here one of those coin swap services that Tung mentioned, you know, sort of advertise exclusively on cybercrime forums, right, to mainly a Russian-speaking audience. And you can see, you know, on the top left there, you've got a Gmail support address, right? So these are not exactly actors that, you know, are, you know, professional, regulated, registered entities. And what you can see here is that with this particular coin swap service, you don't have just the ability to swap, you know, Bitcoin to another crypto asset, but what you also have is the ability to swap Bitcoin directly, cash out your Bitcoin or Litecoin, whatever it might be, to certain sanctioned banks that have been sanctioned by, for example, the European Union, by the United States as well. So interactions with these services that facilitate cross-chain crime, do have potential sanctions implications. Can I have the next slide, please? And, you know, here is an example of how such a coin swap service might be advertised on a certain illicit cybercrime forum. You know, they're not necessarily making any sort of disguising of the fact that they are offering services to sort of what they call whiten your crypto, so clean your crypto. A lot of them will potentially charge a bit of a higher sort of transaction fee if you know your crypto is definitely illicit, you know, directly originating from a dark web market, etc. But you can see here in this particular you know, advertisement for one, they're not making any secret of the fact that they do cater to a cyber criminal audience. Can I have the next slide, please? And here are two services that we've actually identified as prolifically, to an extent, using coin swap services to cash out their funds. One of them is Sanctions, so Hydra, of course, the biggest darknet marketplace of its time, which was seized and sanctioned earlier this year following a sort of cross-border cooperation by numerous different law enforcement authorities, was using coin swap services prolifically. In fact, when you looked at the funds originating from dark web markets, coin swap services were the main type.
So everyone, it seems that Arda's connection might have been interrupted. Maybe you could just wait a while for him to come in. So while waiting for him again, if you have any questions, feel free to put them in the Q&A section so that we can potentially answer them later. Yep, Arda's back.
Apologies, not sure what happened there. Maybe my own computer got bored of me. I do apologize. So yes, as I was saying, the BTCE site you see there was associated with potentially laundering, you know, ransomware proceeds and dark web market proceeds, etc. And that was another major user of CoinSwap services to launder its illicit funds. So if I could have the next slide, please, Tung. It's not, of course, just, you know, sanctioned entities, but it's also designated terrorist organizations as well that use these services. Right here, you see a Telegram channel affiliated with Islamist terrorist groups, right? Al-Sadaka. There you have a Bitcoin donation address there, and what we've identified is that when we sort of screen this Bitcoin donation address and look at, you know, where it's been receiving funds from and where it's then putting funds into, a lot of it is coming and then going to CoinSwap services. So you see here that there is a significant sort of sanctions, evasion and terrorist financing elements to the use of these services. Could I have the next slide, please, Tung? So moving on to cross-chain bridges, we've got a sort of similar profile of risk, right? First of all, we've got major ransomware operators like Conti. Conti was a Russian cybercrime, well, is a Russian cybercrime group that pledged allegiance to the Russian government in the first day of the full-scale invasion of Ukraine. It said that it would retaliate if any Western government engaged in any kind of cyber warfare against the Russian government. That led to a fallout within the Conti group, which I will go to in the next slide. But of course, it's also worth noting that Ponzi schemes are also a major user of cross-chain bridges. You can see Finico here, which was a Russian Russian-speaking Ponzi scheme that made about $1.5 billion worth of funds before collapsing, and has used cross-chain bridges in vast to launder the vast numbers in Bitcoin ever since. If I could have the next slide, please, Tony. Right. So, as I mentioned, Conti, of course, is a major cybercrime group, a major ransomware group. When it pledged allegiance to Russia in the first few days of the full-scale invasion, there were some individuals, of course, that were predominantly Ukrainian individuals that were, of course, not very pleased by that. And what that resulted in was what we call the infamous Conti Leaks, which were tens of thousands of different messages affiliated with senior operatives of Conti, showcasing exactly how the group worked behind the scenes and the sort of, the laundering patterns and the ransomware initiation patterns, and also a lot of crypto addresses for blockchain analytics companies like us to then identify and look into. And a recent investigation that we've done actually into these disclosed Bitcoin addresses belonging to Conti is that they are a prolific user of cross-chain crime and cross-chain bridges in particular to launder their assets. In fact, this is a small snapshot of a particular investigation that we've done into a senior member of the Conti ransomware gang called, nicknamed Target. And he's, of course, wanted by the US government. And what we've identified, thanks to holistic screening and looking through all of these, different DEX swaps and all sorts of, cross-chain bridge swaps, etc., is that what started out as Bitcoin going into a wallet that we associate with medium to high confidence with Target has actually ended up through all of that chain hopping and asset hopping into an Ethereum address that has DAI in it, $19 million worth of DAI. And that was put in there, as I said, with multiple chain hopping and asset hopping, just really showing that without this holistic screening capability, there is the risk that that kind of investigation becomes practically infeasible to do, given how much manual investigation it would have to involve. If I could have the next slide, please, Tung Lee. Just to note that we do have an abridged version of that investigation available for download on elliptic.co. You can read it in the form of a briefing note, and we have more details available if you are from a law enforcement entity. So please do get in touch with us if you would like to see a detailed sort of, a detailed version of that investigation, if you like. And that QR code there will lead you directly to the page in which you can download this briefing note. Okay, if I could have the next slide, please. Thank you. So going finally to the sort of major hack that's been discussed in the sort of, in the last few weeks, of course, is that of FTX. So FTX, I mean, if I could go to the next slide, please, Tung Lee. What as many of you will know, it's been in the news prolifically for the last couple of weeks. About $482 million worth of assets were stolen from FTX through a hack. One of their senior officers said that this was sort of a attack on their system. So we've actually done some extensive investigations into sort of identifying exactly how much was hacked and how much of those wallet movements are sort of associated with administrators moving in, given the sort of recent bankruptcy declaration. What we've identified is, the total stolen amount of assets is about $482 million worth, and about $266 million worth of that was processed through DEXs, right? So well over 50%. And a further $106 million worth of it was bridge cross-chain. And specifically about 4,540 Bitcoins were processed through Ren. Now, Ren is a particular cross-chain bridge that we've identified as facilitating over $500 million worth of illicit activity, ranging from Ponzi schemes to ransomware, etc., as we've just discussed. But, and it's also worth noting, of course, some of those figures that you're seeing on the screen, 106 million, 266 million. Some of those funds have flowed through both services. So DEX, processed through a DEX and then through REN, for example, to then reach the Bitcoin blockchain, after which, we presume that, potentially mixers or other such services or coin swap services to cash out directly will be used. So it's, not necessarily the case that, we can add those two figures together. But when you look at, just how much of the post-hack laundering from the FTX fallout has occurred through cross-chain bridges or DEXs or services that can facilitate cross-chain crime, it's well over 50%. And especially with the recent sanction of Tornado Cash, this is definitely a trend that we are seeing increase and is more than likely to increase in the future. So I think just those examples and those sort of case studies, if you like, very much showcase how important it is to have these capabilities and how easy it makes certain investigations involving cross-chain and cross-asset swaps. So if I could have the next slide, please, Tung. Here is a breakdown of the DEXs that were used during the hack or after the hack of FTX. You can see a sort of similar, sort of breakdown with the sort of Sankey diagram that we had earlier. Half of it has gone through COW. Some of it has gone through 1inch, which is an aggregator, Pancake Swap, Curve etc. So you can see all of these different DEXs can be used and have been used in the laundering of a single hack. And of course, Elliptic has coverage of all of them, which allows the holistic screening capabilities that we have to be used effectively to sort of trace through these DEX swaps. If I could have the next slide, please. That's all I have for you on my side. I'm more than happy to take questions. I hope that was interesting to you.
Thanks, Arda, for showing us how holistic screening can help law enforcement as well as crypto businesses to address cross-chain crime and trace illicit proceeds across assets and blockchains. So there's still time left. So let us go through a couple of the questions that we have received and not yet addressed by either me or Arda. So I think one question was, how do state-sponsored actors evade US imposed sanctions using chain hopping? So as shared by both me as well as Arda, so certain sanctioned actors, state-sponsored actors such as the Lazarus Group, have been found, as we mentioned, to have laundered over 350 million worth of illicit crypto through cross-chain services. And these largely were done through the use of DEXs, bridges, as well as coin swap services. So these are also examples of cross-chain services that such sanctioned actors use in order to basically facilitate chain hopping to evade tracking of their illicit funds. So I think we've shared that. Let's see. I think there was one question which we've answered on the Q&A. And then, do you have any other questions from the audience? Yes, Arda, I think there was also another question from the pre-submitted list, which is how can financial institutions operate cross-chain without facing financial crime? How do you look on, what's our views on cross-chain risk between different private blockchains? And what are the tools that can potentially secure such private blockchains? Do you think you can help answer that?
I'm assuming that by private blockchains, we're talking about Monero, for example. To an extent, we might be talking about the Lightning Network, on Bitcoin, for example, that has the capability of sort of anonymizing certain transactions. When we sort of look at coin swap services in particular, a lot of them do have the capabilities to convert normal non-private crypto assets, if you like, into privacy blockchains such as Monero. Actually, in a couple of slides back on the coin swap services slide, you would have seen that one of the examples I put on there, you can use the Lightning Network and you can convert into Monero as well. I think in this particular case, what Elliptic does offer is a very, very good coverage of these services, right? So these services for us, of course, are a priority because, as the question suggests, it is, of course, a priority for virtual asset services and criminal investigators as well. We need to sort of be able to understand and identify, transactions, blockchain transactions that are going into certain coin swap services and other cash out services that do facilitate trades into and out of Monero and other sort of privacy enhanced blockchains as well. So we do look at those as a priority. We have good coverage of them within our tools, and with the enhanced capabilities of holistic screening, we of course have the a much better sort of ability to view the sort of potentially convoluted money laundering schemes that certain criminals might use to sort of reach those services, or sort of take funds out of those services for other illicit activities as well.
Okay, so we have just received another question, basically asking about the secret sauce of how we can detect cross-chain transaction flows, given that coin swap services or DEXs would not share information that can be used for us to make the connections with labeled entities and so on. So Arda, are you able to take that without sharing too much?
Yes, I'm not too much a data sort of scientist or a sort of product developer myself. So I'm sure some of our amazing team, which are far cleverer than I am, will be able to give you a much better answer than what I'll be able to offer. But I'll say, in a very, and apologize for how basic this might sound, but basically, when you look at decentralized services like cross-chain bridges and DEXs, of course, because they are based on smart contracts, and because therefore all of the sort of transactions that they facilitate are on the blockchain and are transparent and are there for everyone to view, it is possible manually to go through them and identify what has been converted into where, by whom, from what address to which address, when, etc. So all of these crucial bits of intelligence are obtainable manually through smart contracts and through transaction details that are available on chain. Of course, it's incredibly cumbersome. It's incredibly manual, and as I kind of said at the start, if you've got individuals that are using several cross-chain swaps and several cross-asset swaps, for example, in the case of the senior Conti member called Target, who eventually ended up with $19 million US of DAI after several swaps and hops, you get a situation where it's not necessarily feasible and will take enormous amount of time to sort of identify those flows manually. And that is the sort of intelligence that we use, and our sort of product looks into to sort of make that far easier through holistic screening.
Yeah, so just to add on, this holistic screening actually builds on our already existing capabilities to use various forms of intelligence, as well as heuristics and machine learning to label entities. So of course, coupling with the ability of holistic screening by examining the smart contracts in GIST briefly, to examine which wallets will be the input and then which wallets will be the output, we are able to identify the transaction flows, and then through that pierce through some of these services to review the risk exposures, because of their interactions with other labeled entities such as illicit actors and so on. So really speaking, that is basically the secret sauce that powers holistic screening. Yep. Okay, so it seems that we have no further questions. I think we can end it before reaching the hour. So thank you everyone for joining us today. If you have any feedback or any other topics that you'd be interested to learn more about, feel free to email us. If not, I would like to bring the webinar to a close. Thank you everyone for attending. Thanks Arda as well for joining us.
Thank you very much, Tung. Thank you everyone.